global debt didn't just appear overnight. It's the result of years of financial crisis, government responses, and economic shifts. From the 2008 financial crash to the European sovereign debt crisis, and more recently the pandemic, each chapter has shaped the debt landscape we're facing today. To help us put the current situation into perspective, I'm joined by StoneX Director of Global Market Strategy, Vincent Deluard. Thank you for joining us, Vincent.
It's a pleasure to be here.
So, looking back at the 2008 financial crisis, what role did it play in setting the stage for today's record levels of debt?
Well, I think '08 was really about a transfer of debt, ultimately. It started on the private sector, famously the mortgage sector in the US, where had a lending boom to people who could not afford their mortgages. And then a lot of that debt was moved from private sector balance sheet to public sector balance sheet. And then 3 years later, we have the European sovereign debt crisis, which, as the name implies, is on the sovereign side. So it's the shuffling of that debt eventually just moved where the problem would appear.
So, the European sovereign debt crisis, as you mentioned, followed soon after the 2008 financial crisis. How did that experience reshape global thinking about government debt?
In many different ways. I mean, in one way, you could say it was a successful financial orthodoxy, in the sense that if you look at the countries that were in the eye of the storm 15 years ago, your Greece, your Italy, your well, Italy's it's Portugal, certainly Spain. They're today one of the best performing economies in Europe, and the defaults that were much feared have been eventually avoided. I mean, there was a little bit of haircut on Greek debt, but it was overall quite orderly. At the same time, if we look at the human toll, we're talking about a decade of 25% plus unemployment rate for the youth. We're talking about cumulative GDP losses comparable to what we experienced the Great Depression. So I think if you ask the average, Greek or Spanish man in the street, he would tell you that the medicine was quite bitter. Um, but overall, yeah, I think it really shows the difficulty of fixing a debt via restraining public spending, because the first effects of the policies that were imposed by the IMF, the ECB, and the European Commission were a huge drop in GDP. So you're trying to cut spending. Because you cut spending, your revenues drop at the same time, and hence you do all this hard work, and you don't reap any of the reward, at least initially.
And how did the ultra low interest rate environment after the pandemic contribute to today's debt explosion?
Yeah, absolutely. I think that's a key factor in the 2010s crisis, and the key difference with where we are today. 2010s was a decade of extraordinarily low interest rates, especially in core countries. I mean, we had close to 20 trillion of debt with a negative yield. The German yield curve was negative all the way to 10 years. I think it went to almost 20 years in Switzerland. And that was um, part of the cure. We had very low rates, so that made this working out these high debt burdens a lot more manageable once we could get the spreads under control, which what basically what the ECB did with its whatever it takes outright money transaction promise. They'll basically the promise that the ECB would buy any bond of a sovereign country under bailout, shrank that spread, and then that brought back borrowing costs. That really helped budgets get better. So that was part. That's I think one of the reasons why we got out of the debt crisis is because borrowing costs were so low. Now, what these very low borrowing costs did, I would say more outside of Europe than inside, is that they incentivize other governments to take more debt because borrowing was so cheap. So we had a the explosion of debt during the pandemic years was in a way underwritten by this extraordinarily low interest rate. And today we are in, I guess, another debt crisis, but we no longer have the benefit of these multi-millennial low rates on debt.
So, when we compare today's debt landscape to those earlier crises, what's similar and what's different?
In terms of magnitude, and I don't always like to compare the debt to GDP ratios because you're comparing a stock to a flow. But that's what's usually done in literature, so I'll go with that. We are a comparable level. I mean, right now, if people think about where is the pain, especially in the sovereign debt market, it would be in places like France and like the UK, where we have debt to GDP ratios that are maybe a tiny bit lower than where Greece was in 2009. But then again, there was some cheating and off balance sheet item. But you could argue there are off balance sheet items also in France and the UK. So we are certainly at closer levels that are close to that. The US is obviously above 100%. Now, I would argue that there is significant differences in the sense, especially for the US. I mean, the US and to a lesser extent the UK are monetary sovereign. So they're borrowing their own currency, while Greece was borrowing in a currency that effectively could not print. France is a little bit in the it cannot print euros, but it's also a lot more systemic to the eurozone than Greece was. So there are some similarities. There are also some differences. Another major difference is the level of interest rates. In Europe, we've come down to close to 2% on the deposit rate, but we're at zero, so servicing costs are much higher. And when you have a debt to GDP ratio of more than 100%, every percent in interest rate is a percent of GDP, so that makes a big effect on your government balance. Overall, I would say it's and if we're just looking at the sovereign side, I would say it's less dramatic. Like we had in 2010s. I mean, we had to shut down the ATMs in Greece. In Cyprus, we literally had to take people's money from their bank account. And I mean, so far, we're not there, and I don't think we're gonna get there in a year or two in Europe.
Now, you touched on this briefly, but which countries and sectors look most vulnerable today, and how do these vulnerabilities echo past crises?
So if we look at a pure um, debt across various categories, I think you have two major pain points now. One is these highly indebted, uh, fiscally challenged, advanced economies, and that's mostly on the sovereign side. And I would say, really, two countries stand out. It's France and the UK. I think they are probably the most vulnerable because of the kind of inability to get the fiscal house in order, and then the underlying political crisis, which leads to instability and the difficulty to accomplish reforms, and the risk of a huge electoral swing at the next election, right? Be it Rassemblement National in France or Reform in the UK. These were parties that were traditionally thought to be not, you know, acceptable, and they will likely have a majority. So that creates it's really the meaning of high debt level, poor fiscal situation, and a regime crisis. So that's one pain point. The other pain point I would say is in the U.S., where we see this private credit. Um, some might say bubble. And again, it all draws back to the experience of '08, right? After '08, the banks got in trouble, so we had Dodd-Frank and a bunch of regulation that made it much harder for the banks to extend credit, much costlier in terms of capital ratios. So nature abhors a vacuum. So where the bank could not operate, we had all these new actors, your Apollos, your Blackstone, Ares Capital, Blue Hole, basically extending credit to subprime borrowers in the car market, consumer loans, also financing a lot of the infrastructure buildup within the US. And it was easy for them to do that because they had less regulation than the banks. And of course, then the banks could lend to these private lenders. And then the lenders, so it just added in kind of a fold in the chain. And today we are seeing some signs of stress. I mean, we had the bankruptcy of First Brand, we had a Tricolor. A lot of that had to do with the reversal in immigration policy. But yeah, I would say that's the pain point in the US. And because of the regulatory situation, we don't exactly know where who's holding that debt. Now, I would say it's quite positive that it's not being depositors that are on the hook. At least that was the premise of the booming private lending. It's going to go to these kind of deep pocket investors that can take a loss, right? Pension funds, endowment institutions. But then again, if we see that the banks were lending to the private lender, we're just kind of reshuffling the pack, but the risk is in the system.
Well, thank you very much for your insights once again, Vincent.
Pleasure.
For more videos like this, please do like and subscribe.